Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri. And look, we got to start talking about precious metals here, and we've been doing that, but gold is really starting to turn around, and we're seeing some conviction over $1,300 here. And I wanted to give everyone an update on this, so I brought on the line Eric Hadik of InsideTrack.com. He's been on the show before, and he's given us some incredible insight on what is going on in the precious metals arena. He's an expert in this. He follows this daily. Eric, thanks for coming on Crush the Street here.
Oh, thanks for having me back, Kenneth, and Happy New Year to you.
Happy New Year. Happy New Year, and Happy New Year for precious metals investors. We're seeing some light at the end of this tunnel with gold. It would appear that maybe 2016 was a false start to the bull market. So kind of let's get your thoughts on gold here, especially as it's strongly over $1,300.
Well, since you brought up the 2016 move, let me just start with a quick overview of what I've been looking at on a multi-year basis. And even, I think, in one or two of our original conversations, I explained why I thought 2016 would be what I called the golden year, but I was also very quick to specify what I meant by that. And what I had described in the year or so leading up to that was I thought that 2016 would give the largest advance in gold in 3 to 5 years, and that is the type of signal you see as a very early warning sign of a market bottoming. And so I was looking for about a 3 to 6 month rally that would be stronger and longer than anything seen in the preceding years. And that would be kind of your throwing down the gauntlet between the bulls and bears, that all of a sudden it'd be something that starts to wake the bulls back up, but doesn't completely disillusion the bears. And so it's the way you see in most major trends, that when as much damage is done as had been from 2011 into 2015, you need a somewhat drawn-out bottoming process if you're going to be setting the stage for a convincing bull market. So we saw that initial surge in 2016, pulled back down into a secondary low in late 2016, and as we entered last year, I laid out a very general outlook of what I thought we'd see, and I described it as being somewhat similar to 2016, but on one lesser degree, and I'm speaking of kind of a wave structure on the charts, but where you'd see another decent rally, but then a pullback that took back a lot of those gains. And what you're doing is building a sequence of ascending lows, which is a very healthy thing from a trend standpoint.
Well, it definitely, I guess, was disheartening for a lot of people, right? You know, seeing gold move after that extended bear market and going into 2016. I mean, that was like the light at the end of the tunnel. Man, this is it. And then for it to kind of pull back, and then consequently the mining shares really suffer after the fall of 2016, I think that was a big blow to precious metals investors. And, you know, I guess maybe we need a little more confirmation now. Maybe people aren't going to be as quick to believe what we might be seeing here in 2018. And maybe we do need something like gold going back to 1290 and going, you know, back up to test these levels and move higher to convince the market. So let's just get your thoughts on what you expect gold to do and just kind of what you're looking for.
Well, when you mention the mining shares, that is a critical distinction that almost every time I publish something about my outlook for precious metals, I really try to draw that distinction. And that is that the mining shares are a different entity. that when you're just looking at pure metals price, that's one thing. When you're looking at mining shares, there are a lot of other factors that go into valuing a company's stock. And I think that sometimes your gold bugs lose sight of that. Often the price of the raw commodity or the underlying focus of that company doesn't equate to or doesn't comprise the majority of the share's value. There are so many other factors. And again, when you have the damage done that you had for so many years, even though the metal's going to respond to different technicals and fundamentals, there's still going to be a lag time before the shares and those companies respond to, because even from a governing standpoint, those companies have been jaded and have been damaged by the lower metals price. And it's a longer, it's like that turning an aircraft carrier around type of analogy, that you can reverse the thrust and start to move some things in another direction, but the actual movement of the underlying shares takes longer to make that turn. And even early last year, I had put out a series of updates on the gold shares in early February, when they had fulfilled some key upside targets and shown some real concerning levels of divergence between them and the metals. And what it was looking like is that the XAU and the HUI were setting multi-month peaks in early February, even though gold and silver, the metals, still had a lot of upside potential for them. And within the context of that overall analysis, what I was repeating throughout most of the year was that it would take until November, December for the gold shares to really bottom out and start to begin a corresponding move up to what the metals were already leading the way with. So when we came into early December, my primary focus was to see a bottom there and an initial advance, a pretty good surge, this time with the shares leading the way into February. And so on a near-term basis, I'm still looking for that. I still think we have another leg up between mid-January and early February. But there is a host of cycles and technical indicators and timing factors that I use that are telling me that February could be a fairly significant peak. But between now and then, we could still see some significant upside. One of my big targets on the XAU, the initial upside target was between 86 and 88 on that index, but there are a lot of intra-month and month-to-month indicators that I use that have been telling me we could get up to between 92 and 93.50 on that index. And that's going to be really the revealing level to me. If we're hitting that in early February, and if there are some related signs of a topping process, then I would think we could see a multi-month top take hold at that point. And as part of a developing trend, you then see another period of consolidation. Probably one of the least healthy things in a trend is a straight up or straight down movement, because usually that's more reactionary in nature and is very short-lived.
You know, it seems like the interest rates hikes have been good for gold. I mean, every time the government raises interest rates, gold seems to react strongly. And that's been the case really since December of 2015. And then I guess, what are your thoughts on just what we're seeing now with interest rates and the dynamic of we're kind of seeing a strong economy here, and traditionally that's not good for gold. So what are your thoughts on the 2018 economy and the perception of a good economy? Is this going to be harmful for gold? Yeah, let's start there.
Well, you touch on a really important and sometimes deceptive interplay in the markets. And it is when you start correlating one market to another. And I'm not saying you shouldn't do that, but it's a very precarious thing, because depending on what the majority of traders are focused on, those correlations shift so quickly and often just, turn on a dime, because all of a sudden something else takes center stage. And there's also the challenge of discerning which is leading which. And when you mention the last couple of years with gold and interest rates, you have seen the type of interplay that you mentioned. But some of that has been, too, that you've had gold kind of being suppressed a bit as traders are anticipating a rate hike. And, historically, rate hikes are viewed as negative for gold because, gold you don't earn interest on. And so if other vehicles start to offer that competing interest, it weighs a little bit on gold. But you saw gold and silver kind of leading into these interest rate hikes having pressure on them, and then the actual realization of that hike is kind of like the buy the rumor, sell the fact, or in the case of gold, sell the rumor, buy the fact, where it takes that pressure off, and all of a sudden gold and silver have kind of rebounded right after those hikes, even though it seems counterintuitive. But then when the market starts to focus on another forthcoming hike, gold and silver start to struggle more and see some selling, and then you get into that much anticipated hike, because the hike is, in each case, it has been factored into the market weeks and months beforehand, and part of that factoring is in the precious metals as well. Once you get the actual realization of that hike, then gold and silver start focusing on other fundamentals. And it's one of those things, too, where I've seen this so many times in the markets over the last 30 years even, that something that is a good scenario for 90% of the time then ultimately hits this tipping point where all of a sudden it turns to a more alarming correlation. And I don't think we're going to see that just yet, where interest rates versus gold are concerned. But it's kind of like, let me give an analogy. Back in the 80s, I remember this with interest rates and the stock market. And interest rates started heading up in, I believe it was early 86, and you saw several successive interest rate hikes, and every one of them was on a growing economy, and so the stock market thought, this is great, this is great. Every time, bonds would take another dive down, and it was on the economic indicators that were looking positive, stocks would go up. Then all of a sudden, you hit that one final interest rate hike in third quarter of 87, and all of a sudden the entire perspective changed, like I said, on a dime. And all of a sudden, all this economic increase and a good economy and the rising interest rates were viewed it went from viewing them very positive, and almost overnight that was suddenly a negative thing. Oh, now interest rates have gone up too much, it's going to weigh on the stock market, and boom, within 2 months you saw a 40% drop in the stock market. You see that type of thing in the markets very frequently, where one correlated event or indicator or economic interplay is good, and then all of a sudden it's it's not so good. And that's one of those things that I think you kind of need to have on your radar looking out maybe 6 months, a year from now, if they do follow through with the 2 to 3 rate hikes that they're talking about in 2018. In the early stages of that, it'll probably still be viewed good for gold. Okay, there's, the economy's going, which is somewhat inflationary, which supports gold. And then you hit the point where all of a sudden it's like, okay, all these rate hikes are now a negative for gold. And like I said, that's out on the horizon more. I'm not concerned with that at this point. But I think but when we're talking about this interplay between the interest rates and gold and silver and the economy, that you need to kind of keep that in mind and be watching the correlations. Each time there is a rate hike, leading into it, leading out of it, are gold and silver responding as positively as they did the previous time, or is there some growing concern there? So I think that we're going to see some more upside in gold in 2018. I think we're probably going to see at least some of those rate hikes that they're talking about, but all it would take is one little glitch in the overall scenario of what's expected to suddenly see a quick, sharp snapback in a lot of the markets.
Well, that's just the thing about the markets. Markets have a way of, I guess, washing and rinsing investors. And even in a bull market environment, it's very easy to not experience it because of sharp pullbacks and investing panics. And then when investors sell, the market moves back up. And even though you look in hindsight, the chart looks beautiful, not many people experience the ride upwards. So can you comment on that and how investors should be playing this going forward?
Are you referring to the precious metals or the market in general?
Well, precious metals, and I mean, if you want to comment on the metals as well as the stocks.
I think that from as far as the playing it, I think you do need to be one extreme or the other, either fairly nimble and be looking to try and catch the 2 to 3 month swings, or on each of these big pullbacks, you're just kind of building a position and not worrying about if it doesn't go to the moon all at once. I think that type of expectation is often very unrealistic, just because there have been a couple periods, really 2008 to 2011 and 1977 to 1980 are the 2 times in the last 40 years where we've seen that kind of move in gold. And yet, so many gold bugs keep expecting that type of move on an ongoing, consistent basis. And it's just not realistic when you can really only find 2 moves like that over the last generation. That's more the anomaly or the exception to the rule, not the norm. And so I think you need to cater your investing and your positions to a little bit more realistic view of the market. And yes, if this is a developing multi-year bull market, there is going to be that type of parabolic move at some point, but historically, it's always at the very end. And I talk about the 90-10 rule of cycles and trends that I consistently see, especially in precious metals and equities as a whole, regardless of whether it's metal stocks or not. And often 90% of a move in price occurs during the last 10% of a cycle or the timing of that trend. So, if you had a 5-year uptrend in gold that started in late 2015, 80 to 90% of the overall price move to the upside might happen in the last 6 months of that trend. And that's what we've seen historically, and that's what a parabolic move is in the markets. So if you're expecting that to happen right after the bottom, then you don't understand what a parabola is, and you don't understand how these markets work on a consistent basis. So like I said, I think you either need to be slowly, steadily building a position as each of these corrections unfold, and gold has been very consistent in testing key support levels and holding them on its respective pullbacks. And by that, I'm talking about late 2016, second quarter of 2017, and then the fourth quarter of 2017. Each time it has pulled back to key levels that were identified and observed well before the fact. So they're the times to be adding to a position and then just steadily holding that, unless you're more of an intermediate trader and you're looking to time the swings and get these 2 to 3 month rallies. But I think what hurts a lot of those traders is they sit and they wait until a bit of an accelerated move starts to turn up, then they jump in, then they're completely shocked why the market tops within a couple weeks and goes into another corrective phase, whereas, as I said, that's the norm for markets. So it's one of these things where you have to identify what your trading objectives are, what your risk comfort levels are, and tailor your approach accordingly. But I don't see a parabolic move out on the near horizon for gold and silver. I think we're still developing this overall uptrend.
Eric, let's get your thoughts on silver specifically. This is kind of like the one that everyone's kind of really hoping will give them the big leveraged move. I like silver a lot. I think there's a lot of potential there. Gold, obviously, I think has a lot of potential, but just the fact that silver's at $17 now roughly, and the Dow, or I should say the gold to silver ratio is at a pretty high extreme. I mean, are you excited about silver at the current time?
I don't think I would use that that description of being excited. I think it certainly has some upside potential in the near term. Although silver is one of those that, for me, has the most or the greatest synergy of timing indicators and cycles and wave objectives that were focused on this February 2018 time frame. And just a couple examples, if you look at since the bottom in late 2015, silver's had 5 significant advances, and each one of them lasted right around 2 months in duration. From December 2015 to Feb 2016, then from March to May of 2016, May to July of 2016, December 2016 to February 2017, and then July through September of last year, 2017. So it's been very consistent in the timing of those upswings and how long it's able to maintain a rally like that. And my thinking was that if we bottomed in early December, when a lot of cycles were arguing for that to happen, and when some extreme downside targets were hit, that we would see an initial 2-month advance from there into February of 2018. But there were a lot of other factors also arguing for that same scenario. I never rely on just one or two factors in the market. I look for synergy, and there are just a lot of things that telling me with silver that we could see a nice rally up into February, but really the key price level for me to watch is right around the 1850 level in silver. And I've described multiple times over the last 3 to 4 years how silver has tended to move in very consistent increments of about $2.50 kind of trading ranges. And that's a principle in the markets that often specific markets will kind of have those type of rhythms within them. And almost every time silver does this, it finds either very strong resistance or very strong support at the extremes of that range. And one of the most consistent ranges has been between $16 and $18.50. That 250 range. And when it has broken above or below that range, it often immediately goes kind of another 250 range. And so you've seen some critical tops and bottoms at $21. And on the downside, when silver had its 1 or 2 breaks below that $16 level, it went right down towards $13.50 and found support there. And so 1850 has been a key level for the last year and a half in silver, and even going back before its 2016 peak, which was up around $21. Again, the next extension of that $2.50 trading range. It found a lot of equilibrium at that 1850 point. So that, for me, is going to be a key level coming into February. I think we could get up to there between now and the first 2 weeks of February, but it would need to convincingly break above that to show me that it's entering a little bit more of an accelerated move up. There are some monthly and weekly trend indicators in my work that have not yet turned as bullish as I would need to see to expect something beyond that. But the weekly trend indicator is one that could reverse or signal this more accelerated move in the next week or two. It's set up to where I'm very close to that, silver being able to trigger that, but it hasn't done it yet. So as of yet, no, I'm not real excited, but I see some decent potential on the upside for silver in the near term. And the one other thing I would point out too, and it's probably not as applicable to silver, but very much to gold. And one of the things that I think might be lost in the discussion over the last year or two is that so often the driving force in gold is an alternative to the dollar or to fiat currency as a whole. And so when the dollar is seeing some weakness or seeing some vulnerability, that's when gold often has its nicest moves up. But the one big thing that has changed in the last year or two is the real proclivity or prevalence of cryptocurrency. And so that particular driving force behind gold, the one of a kind of a safe haven status or an anti-currency status, gold has now had to split its benefits from that mentality with cryptocurrency. And so you've seen a lot of your anti-dollar, anti-fiat currency money move into Bitcoin and Ether, Ethereum, and most recently Ripple. And so that's something that is really competing with gold for that safe haven status and safe haven money. So I think that that's one of the things that has kind of kept the ceiling on some of these rallies in gold. And again, not that that's the only factor, and I don't know that interplay really works in reverse, where gold is really not pulling anything away from the cryptocurrency, but cryptocurrency, in my opinion, is definitely pulling some of that appeal away from gold. And so that's something that I think, even looking forward, you're going to continue to see that competition in the marketplace for the anti-dollar dollars.
Very interesting. Eric, yeah, I tend to think that as well. But you know what? I'm also thinking 2018 might be a turnaround year for the metals. It's feeling like that. And I'm very optimistic to see what goes on in 2018, and really anticipating some momentum to be built up with gold and silver. So Eric, thanks for coming on Crush the Street. If people want to learn more about what you do and follow you and receive your content, let them know where they'll go, and we'll be sure to have the links in the description area as always.
Well, they can go to our primary website at insidetrack.com, and that's spelled with the extra I in the middle. So it's INSIIDETRACK.com. And through the contact page can contact us, request samples and trials. Can also see some samples on that site. But we've also built a secondary website, 40-year cycle, with the numbers 40 and then the words year cycle, where we've archived a lot of articles and reports and analysis that has been done over the last 5 to 10 years. So it gives an even more comprehensive sampling of some of that work. And there's also contact page there too. So either one will get to us as far as looking for additional information, samples, trials. And I'd be happy to send out even my January Inside Track, which was just published and kind of lays out the wave structure that I see in gold and where I see it going in the coming months. So that's something I'd be happy to send along too. So they're probably the two best ways to contact us.
Excellent. Well, Eric, thanks for coming on crushthestreet.com. I appreciate your time with us. And we'll be sure to have you on soon for some follow-ups, especially as these things play out.
Thanks so much for having me back, Dennis.